What if your startup sold for $10 million and your investors got paid millions before you saw a single dollar? That can happen because of one line in your term sheet. This is day 8 of my series on startup law. When founders raise money, they are usually focused on one thing: the valuation. $5 million valuation, $10 million valuation, $20 million valuation, but sometimes the terms matter more than the headline number. At pre-seed, startups commonly raise using instruments like safes, but in priced venture rounds, you'll typically negotiate a term sheet covering the major economic and control terms of the investment. And one of the first things I'd look at is the liquidation preference. In simple terms, it determines who gets paid first and how much when the company is sold or liquidated. Imagine an investor puts in $2 million with a 2x liquidation preference. Depending on the exact terms, that could mean they are entitled to receive $4 million before common shareholders receive proceeds. A 3x preference could make that $6 million. Personally, I would push back hard on a 2x or 3x liquidation preference. I think 1x is a much more founder-friendly starting point. But here's the bigger lesson. Your ability to negotiate depends on your leverage. The worst time to negotiate is when you're desperate for cash. The best time when your startup has runway, traction, and multiple investors who want into the round. Don't celebrate a term sheet just because someone offered you millions. Read what those millions will cost you. Valuation gets the headlines. Terms determine what you actually own and potentially what you get paid. This is day 8 of my series on startup law. Follow for day 9, where I'll cover another legal mistake that every founder should know before it's too late.